Welcome to Talk Tickers. We extract the essential knowledge from complex earnings calls so you can move faster.
Today, we're analyzing the Q3 fiscal year 2026 earnings call for Asana. This was held post-market on December 2nd, and it covers the quarter that ended October 31st.
Right, and our mission here is really to unpack the story behind the numbers. Specifically, you have this huge shift to profitability clashing with concerns about slowing growth and retention.
And then there's the AI narrative. Is it convincing the street? We're going to cut through all the noise to deliver the key insights you need.
Okay, so let's kick off with the high-level metrics. Overall, this quarter was a modest beat on both the top and bottom lines.
Yep, that led to a small but, positive move in the stock right after the call.
So what were the actual numbers?
On revenue, they delivered $201 million. That's up 9% year over year, and it did exceed the high end of their guidance.
Okay, so a slight beat.
A slight beat, but the crucial part was the non-GAAP result. Non-GAAP EPS was 7 cents versus a 6-cent consensus. That makes it their second consecutive quarter of positive non-GAAP earnings.
And that really is the headline, isn't it? This massive shift in profitability and cash flow. We saw a 12 percentage point swing in the non-GAAP operating margin year over year.
Which is huge. That led to $16.3 million in non-GAAP operating income.
And for investors who are really focused on efficiency, this next number is even more critical.
It is. Adjusted free cash flow flipped dramatically. It landed at a positive $13.4 million.
Wow. And compare that to what?
A negative $18.2 million in the same quarter last year. So this really confirms that the operating leverage they've been talking about is finally taking hold.
Okay, so that's the good news. But if we dig into the customer metrics, there's a bit of a mixed signal here.
There is. Core customers, so those paying more than $5,000 a year, they grew 8% year over year to about 25,400.
But the most important cohort, the really big spenders.
The 100K plus customers, they grew 15% year over year to 785. That double-digit growth in large customers is what shows they're getting that enterprise traction.
Right, but the persistent concern, the thing that just won't go away, is retention. The overall dollar-based net retention rate, DBNRR, it ticked up a little, right?
Sequentially, yes. Up to 96%.
Right.
Management was really quick to point out this was an improvement from the trough in Q1.
But 96% is still, it's still contraction. And it gets worse when you look at that big customer cohort.
Exactly. For those all-important 100K plus customers, their DBNRR is down 3 points year over year. It's also at 96%.
So even their biggest, stickiest customers are on average spending less than they were last year. That feels like a major red flag.
It is, and the CFO had to address it. He really emphasized that the profitability gains are structural, not just, temporary cuts.
So they're building a financial cushion in case this retention issue doesn't fix itself quickly.
Precisely. They got that 14-point improvement in margin year to date by keeping R&D and sales and marketing dollars down year over year. They talked about optimizing cloud costs, shifting talent to cheaper regions.
All things to drive sustained multi-year margin expansion.
Right. They reinforced this belief that they are at or near the floor on that net retention rate, citing 2 quarters of improvement. But, the market needs more proof.
Which brings us to their strategy, because you can't just cut your way to growth. The new CEO, Dan Rogers, is anchoring the whole strategy around AI.
He is. He's positioning Asana as a human plus AI collaboration platform. It's a clear move away from just being seen as a generic task tool.
And this strategy rests on what they're calling the 3 Cs.
Correct. The first is context, which comes from their work graph data model. The second is checkpoints, so human approval loops. And the third is controls for enterprise governance.
So the argument is that this combination is what differentiates them from, say, a simpler Copilot or other functional agents out there.
That's the pitch. And the product pipeline is built around this. You have AI Studio, which is already gaining some revenue traction, and the newly announced AI Teammates.
AI Teammates, these are the agentic collaborative agents, right? They're supposed to be generally available early next year.
Yes. And they gave some pretty compelling examples of productivity gains, like a 2-week product management task being done in just 10 to 12 hours.
That's a massive productivity lift.
It is. And beyond AI, the other major strategic move is expanding into regulated markets with Asana Gov.
Right. They got their FedRAMP Moderate in-process status.
Which is a huge deal. It opens up the entire U.S. federal and regulated industry market for them. Availability is expected to start mid-December 2025.
And it's also worth noting the leadership evolution that was announced.
Yeah, the COO roles being eliminated. All the go-to-market leaders now report directly to the CEO.
Which was framed as a move to optimize structure for speed and focus. The CDO said he wants to inject more tempo into the organization.
Faster decision-making, rapid iteration, beta launches.
Mm-hmm.
It all points to a sense of urgency.
Okay, so with all that strategy in mind, let's look at the guidance. How do they back this up with their outlook?
Well, they showed confidence by raising the full-year FY26 guidance. The revenue outlook was raised to between $789 and $791 million.
Which is still only about 9% year-over-year growth.
It is. But they also raised the non-GAAP EPS guidance to between 25 and 26 cents. So they're really leaning into that full-year profitability story.
What about for Q4?
For Q4, they guided revenue modestly ahead of the street at $204 to $206 million. That's about 8 to 9% growth. And non-GAAP operating income is expected to be between 14 and 16 million.
So they're saying the guidance raise reflects the Q3 beat and their confidence in enterprise, but they also admitted some headwinds, right?
They did. They confirmed macro caution persists, but they also called out top-of-funnel pressure from, and this is interesting, LLM-driven changes in search.
And that's a really key point for you, the listener. What that means is, as AI starts giving you direct answers instead of a list of links, it gets harder for smaller businesses to just stumble upon a tool like Asana.
Right. It's a structural headwind for that small business segment, and it's something that just being more profitable can't solve on its own.
Okay, so let's talk about the investor context. The market reaction was positive, but just barely. A gain of only about 4.9%.
Yeah, and the context here is key. The options market was implying a much, much larger move, something like 13 or 14%.
So what does that tell us?
It suggests the result was better than feared, but definitely not thesis changing. No one is suddenly convinced this is a high growth story again.
And the stock has really underperformed its peers.
Massively. It's down 11.5% over the last 3 months, while the IGV software index is up about 5%. Skepticism is just deeply entrenched right now after the past guidance cuts and the CEO transition.
We also saw a lot of interest around the call itself. Volume was way up.
2.5 times the normal average. And what's really notable is that traders had bought way more put contracts leading up to the report, up 81% versus normal.
So people were either hedging or making some pretty big bets on the downside.
Exactly. Bets that basically decayed to nothing when the move was only mildly positive. The market was braced for a collapse that just didn't happen.
Which brings us perfectly to the segment that is, of course, for informational purposes only.
This is not financial advice segment.
Okay, so given that low realized volatility and this incredibly strong commitment to margin expansion, the CFO is talking about long-term margins in the 20% range, there's an interesting setup here.
A real risk-reward asymmetry. The downside seems somewhat protected by this new efficiency floor, but the upside from the AI catalyst isn't being priced in at all.
The market just doesn't believe it yet. So the trade pitch here is a targeted bullish play. You're betting on that NRR floor holding and the AI catalyst actually hitting.
Right. We recommend establishing a bullish risk reversal. It's a synthetic long stock position, and you'd be targeting the $16 to $18 range before the next earnings print.
Can you break down how that works?
Sure. You sell out of the money puts at a lower strike price, and you use that premium you collect to finance the purchase of calls at a higher strike.
So you're capitalizing on the high implied volatility for that upside move while betting against a major collapse.
Exactly. You're exploiting the disconnect between management's confidence and the market's skepticism. If that net retention rate rises just 2 points next quarter, this trade could pay off handsomely by forcing the market to re-rate the stock on the growth factor.
Okay, so to wrap up this deep dive, Q3 confirms the new management is executing the efficiency playbook. Positive free cash flow, structural margin improvements. It's all there.
But the path forward now depends entirely on 2 things. First, proving that net retention has truly bottomed and is on its way back up.
And second, that these differentiated AI teammates and Asana Gov can actually reignite durable double-digit growth for fiscal 27.
Right, the pressure is on.
So we leave you with this provocative question to explore. Given those strong long-term margin goals, can the company really sustain the aggressive reinvestment needed to win the AI agent race against giants like Microsoft without sacrificing the very efficiency the market is finally rewarding them for today?
Thank you for joining us for this analysis. We hope this knowledge helps inform your next decision. You can find more of our deep dives wherever you listen.